this sort of is a common theme among us all. You've got to be clear, okay? Saying I think you mentioned something like, can you see how that doesn't really convey a lot of confidence in even what I was talking about? So if you're confused with the interpretation, you've got to be very clear on what I said. Okay? So understand that is just a vital portion of communication. I don't know how you come up with this conclusion. Is there a webinar or an advanced tactics video somewhere that explains these interactions in greater detail, and is there possibly somewhere document download where these rules are written down? No, there's no document download. And the advanced tactics videos actually go into quite a bit of detail. I'm not quite clear on what specifically you're looking for. If you review the weekly wraps for the last several months, I've gone over this concept in great detail. In fact, this last Friday, I went over several different scenarios, so maybe you can actually get the detail that you're looking for there. So I'm not exactly sure what you're looking for specifically, since I'm not sure what from the September 14th video you're pulling out, but let me comment on this anyway. So closing down on higher volume is usually a good sign of a reversal. When the market's moving down and you see that the market is closing, and it doesn't matter what the market is, closing down, you see this is almost at the bottom. There's just a little tail. You may not be able to see this in the video, but there's just a little tail sticking out there, a little wick. Over here again, closes very, very close to the low. When you see the market do this on low volume, what that tells me is that the professional money is trying to move the market lower in order to accumulate to accumulate inventory at a lower level in order to eventually move prices up. Now, what you have to avoid at all costs is assuming that when I say that they're trying to move the market up, that they're always right. Okay? And here's a very good indication. Professional money moves the market down, the market trades sideways, pops up a little bit, but then what happens? Boom. Trades right back down. This is the Little Dipper process. So you see the market moving down. When they bring the market back up into the old area of support, which is now resistance, what are they looking for? They're looking for selling. Okay? What do they find? Selling. Okay, the market then starts to move down. So let's go fast. I think there's a good example of this over here. Well, you know what? I'll use a different instead of the current market. Okay, so when you look in this area here and you see that the market is moved down and it's on high volume, it's closing near the lows, the market reverses. So the question is, how do I come to this conclusion? Well, it's not just as simple as saying that you see the market move down and then you see a reversal. It's a process that develops over time. The time could be 5 minutes, it could be 15 minutes, it could be an hour, but what clues you in on the possibility of the reversal in the first place is when you see high volume. So you see high volume coming in on this bar. Now these are hourly bars, so there's plenty of time to think about this. As the market spikes down, you see big volume come in. How do I know it's big volume? Because I'm comparing it to the past. I'm also comparing it to this blue line here, which is the average. So compared to the past, compared to the average, it's big volume. I'm expecting a reversal. How will I know that the market is reversing? Well, it will again be a combination of volume and price. So if I see that the market is continuing to move down and volume is staying relatively it's average or less, then I'm thinking, okay, this move is going to continue down.